Welcome to Accounting High.
With the management team, we'll take all of our objectives for the year, and then we'll break it down what needs to get done this quarter, and then who's accountable or who's responsible to make sure that that happens. So we look at what are the things that we need to look at quarterly. So it's the biggest things. And the reason it's called rocks is if you filled up a bucket with the biggest things first, you fill it up with all the rocks, right? Those are the big boulders, the big rocks. And then it's the little sand and the smaller things that fill it up, that fill up all the crevices. So you want to look at what are the biggest, most important space, the things that take up the most space, that are most important to move that forward. Because if you fill the bucket up with just rocks, you'll be okay. You don't necessarily need all the sand, but the sand comes in, and that's all the smaller things, the monthly and the weekly things that keep it full. And keep. I don't know if I'm doing it the right analogy, but that's the idea behind rocks.
Check out the Cash Flow Show. We discuss topics like getting paid on time, profitability, and managing your bottom line, payroll best practices, the best apps to use, and cash flow forecasting tools. So if you're a small business owner, your help's right around the corner. Fret not. Tune in as Scott and Nikole help you reach your goals on the Cash Flow Show. The Cash Flow Show. Listen and learn. We'll show you how to pay yourself on what your business earns. With Nikole and OKR.
Welcome back to the Cash Flow Show. What's up, Nix? Happy Valentine's Day.
Hey, I like your red hat and your whole outfit. Reminds me.
I'm actually wearing all red from top to bottom, tip to toes. My shoes are all red, everything.
Your undergarments?
No, actually blue and black today.
Oh.
Typically it's all red, but no, not today. I didn't go that far. I actually didn't realize it was Valentine's Day again until I started putting my actual clothes on. So I was like, "Oh, I got to wear red." But today, yeah, very special day. We've recorded on Valentine's Day for the last 3 years, I think. So nothing new for us. We've recorded on your birthday on the Cash Flow Show. We've recorded on Valentine's Day. Extra special today. Very heartwarming episode. What are we talking about today?
Today we're talking about reporting rhythms. Basically all of the cadences annually, quarterly, monthly, weekly, daily. What are all of the things on the accounting and finance side that need to happen to keep your business moving forward profitably?
So most business owners, the ones that typically come to us in a mess or in array that aren't used to looking at reports because they don't mean anything to them, can we at least explain to our students, our listeners, why these reports should be looked at in any rhythm, or why they're important? Why should they care?
Yeah. So that's a common problem. Small business owner starts out, they have some sort of resource. Typically that resource is reconciling transactions in QuickBooks Online and giving them reports. And at that point, the business owners, they're taking the reports and they're probably not even looking at them because they're not very useful, or maybe the business is small enough where they kind of know what's happening. And then as the business grows and the business owner adds on more partners or layers of management, more complexity to the business, then it becomes more important to start really being clear about what metrics and reports are valuable to your company. And so while we have our standard reporting and data that we look at, every business needs to be looking at, that we'll get into here, we're also going to talk about this idea of how do you set the business up for success so you know where you're going, and then you actually back into, based on our goals, what are we regularly looking at as a business, as a management team? What are the weekly targets that our team needs to hit in order to achieve our goal or our plan or our strategy? Mm-hmm. So that's really the foundation of where we're going to start today.
So you take the bigger things, the bigger goals, and then you break them down into smaller, different things that you can see at a regular cadence, a regular reporting rhythm to make sure that you're on or off track for your goals. Is that right?
That's right. We want to be kind of like, it's like I like the name of our topic day, rhythms, because it ties back to the rhythm of music or the rhythm of your heart and all things
The beat,
Valentine's Day related,
the
the
rhythm
beat.
of the beat. Yeah.
And so that we can fall in love with our business again.
Oh, that's actually very heartwarming message for today. Very important for business owners to love their business and appreciate their business, because that's what provides for them. And if they feel like it's sucking them dry and they resent it, then they're not going to treat it with the love and care that it needs to grow and to flourish. So we want to provide financial clarity within and outside of their business so they can feel like it's fulfilling them again.
Yeah, and I go through stages like this, and typically it's like when I feel like I'm in maintenance mode and I don't have time to step back and really get excited about what's the vision for the business. And so starting with a business plan, doing that regularly is something that can reignite your energy. And so the first item I have that I want to talk about today is a business plan, and this is something that I'd recommend. A lot of business owners don't do this, or maybe they wait till a certain size before they actually do this exercise for the first time. And the business plan is really thinking about, what do the next 12 months look like? Who do we need to hire? What strategy do we want to take in terms of the types of businesses we want to work with, types of customers we want to work with? What is our pricing strategy? What is our sales plan? How does that lead to our marketing plan? What projects or actions do I need to take to achieve the plan? And so one thing that we do we just got off a call actually. So Peter is our advisor on our team. And what we've done before is daily, like 1 or 2 day workshops, which we can do in person, or we can do them over Zoom and like half day workshops. But we were just talking to a prospect just before this, and like they're at a point where they've got 3 business partners, and they're a profitable company, but the challenge is it's high level work that the business partners are doing. So the open question for them is, what does that business model look like if they start to hire employees? What do they need to charge for it? What is the market willing to pay if it's not the owners doing the work, which they can charge $300 an hour for? But if you're bringing in somebody and can they bring on someone that can actually perform the work at their level, or do they need to work from do less strategy and more recurring deliverables? And so now we need to get all 3 people in a room and work through what is the strategy for the next year. And obviously the more people you have involved, the more challenging that is to get everybody aligned on that direction.
Yeah, so you need to reset to review what the business's goals are for the year and what all of the owners should be doing strategically to get there. Yeah, that sounds like something that, everybody should revisit. Maybe business plans aren't just for a new business starting out, too. Maybe it is to reset any existing business.
Yeah, absolutely. And as you know, like we don't typically work with startup businesses. It's more of your ongoing operations, and it can really realign and reinvigorate the company, especially if you've gone off track. And it really comes down to like the foundation of all this is good financials, because if we don't have good financials, it's really hard to put together. If we don't know where we've been, we don't know where we're going. And so something that might come away from that strategy meeting is like, hey, we need to do this first project of putting together good financials. Then once we have the business plan built out, so we know historically what your margins are, and if they're good, we can use that as a foundation. If they're not, then we can talk about how do we adjust your pricing or your cost structure. Then once we know your margins, we can build out the next 12 months of what does the plan look like. And then we can take that plan and we can put it into QuickBooks Online or whatever tool we're using, so that we can look at the plan to actual, whether that be on a monthly, quarterly, or semi-annual basis, to understand where we need to pivot if we're not on plan.
Okay, so on or off track and keep moving forward. So what I don't understand is, how is this like business plan different than a budget? If you were to just put a budget together and look at that, because that's what accountants are used to doing. That's what we like to do. We like to look back and make a budget.
Right. And I like to call a plan, because a budget feels like constrictive. And sometimes what people will do is they'll, sell you a budget, and basically all they're doing is they're taking last year's financials, asking you what your revenue goals are, and then they're fitting in the expenses. And it's not really an exercise of getting the business owner or owners to really think about what they want to do next year. Also, you're not walking away with action items or projects that you need to tackle to drive toward that. And so that approach of just taking whatever last year happened and trying to replicate it in the following year and say, okay, like you can't spend more than X amount on marketing. Well, why? Like maybe spending more on marketing will drive more revenue, or maybe we want to switch from a service model to a productized service model, and we want to invest in developing this new software. Like there's so many things that are going on in the owner's mind, and so we really need to dig into what does the business owner want, and then how does that drive our marketing plan? How does that drive who we need to hire, where we need to invest, and how do we project out what sort of return that we'll get if we do make an investment in this new product or service?
So it sort of goes back to mindset. I think looking at it like a budget would be sort of a scarcity mindset, the way of looking at it. And this is how we did it. This is how we're going to do it. And we can't change. This is the buckets that we're working with for each expense category. Whereas looking at it like a business plan and looking at your goals and trying to tie to them, you can completely change up what you did last year. What you did last year has no bearing on what you're going to do in the next year. So you're not stuck in that Sally mindset. Same as
Sally
last year.
mindset. Yeah. For those who aren't accountants, Sally stands for same as last year. And it's something that auditors do when they're preparing work papers.
Yeah. So we don't necessarily want to keep going back to that.
Right. So when we walk away from, we've done the exercise, we have the plan. So that's going to help us decide on our target. So last episode, we talked about the 50-30-20 rule, or no, that was in the first episode, episode 1. So I talked about the 50-30-20 rule. Now you walked away and maybe your 50-30-20 rule is 60-40-10 or whatever it's going to end up being that you decide on. And then you'll walk away with sales targets. And then from that sales target, let's say your sales target is $1 million a month. Then you can start to break that down into what do we need to do on a weekly basis? What are the activities we need to do on a daily basis?
Keeps everybody focused, keeps all the targets visible too. So it's not just something that we talked about a couple months ago, and then we're going to go back and review it again. This is something that's constantly looked at and reviewed.
Right. And it engages everybody else in the organization too, because you're going to take those targets back then to other people on your team and say, hey, this is your daily target. And so they have something that they're driving toward that then wraps up to what is the organization trying to achieve. And there may be other things that come up during the planning process that comes up as roadblocks or hurdles or projects. So for example, a client that we did this exercise with, something that came up was they had collections issues, and the challenge is they work with their customers. So they do restoration and remediation. So somebody has a flood at their house, they go fix it. Now, the insurance company ends up doing the payout on those. And so while their margins are really high because it's the insurance company ultimately that's paying the cost, the insurance company has claim adjusters. And so they're consistently fighting back and saying, we're not going to pay that. And so they had a really high amount of write-offs that they had to do. And so that became an important issue that we then have to go say, we need to track and understand which types of customers, like if the commercial or residential or certain insurance carriers are more challenging. And then also Peter, our advisor, went and found a attorney that specializes in these types of contracts and put something in the contract so that if they do have to go litigate, that the customer pays the attorney's fees. So that's a long-winded, story there, but it becomes, again, it goes back to what do we need to track and what do we need to do because we've identified this as an issue.
Yeah. So it just keeps everybody looking at eyes on the target and making adjustments and pivots as you go to make sure that you land on those targets. And the only way to do that is with some clear visibility.
Exactly. So now that we've walked away from our annual planning meeting, we can get into, would you want to start with weekly or quarterly? I think let's start with weekly.
Well, so what we should do is talk about, so that was the big annual. we should move down to quarterly, because one thing that we do in EOS is we talk about setting those goals and then creating rocks every quarter. So those are the big things that need to happen. So with the management team, we'll take all of our objectives for that year, and then we'll break it down what needs to get done this quarter, and then who's accountable or who's responsible to make sure that that happens. So we look at what are the things that we need to look at quarterly. So it's the biggest things. And the reason it's called rocks is if you filled up a bucket with the biggest things first, you fill it up with all the rocks, right? Those are the big boulders, the big rocks. And then it's the little sand and the smaller things that fill it up, that fill up all the crevices. So you want to look at what are the biggest, most important space, the things that take up the most space, that are most important to move that forward. Because if you fill the bucket up with just rocks, you'll be okay. You don't necessarily need all the sand, but the sand comes in, and that's all the smaller things, the monthly and the weekly things that keep it full. And keep, I don't know if I'm doing it the right analogy, but that's the idea behind rocks.
I know what you're saying, because the challenge is, right, if you put in all the sand first, then you don't have time to get to the rocks, and the rocks are the most important things. So we need to write down and be driving toward, so we don't get distracted by the little things that don't move our business forward.
Yeah. So to answer your question, let's start with quarterly then. Let's start talking about that.
Okay, good. So now that we have the business plan and we've imported that into your QuickBooks Online or Xero or whatever third-party tool that you're using, we can monitor that. And so every quarter, maybe we're having a meeting between the business owner and your advisor. And we are, and not to say that we're not on a more regular basis meeting, but this is more of like, hey, let's get everybody who needs to be involved in this. Let's look at the past quarter, figure out now that we know what happened. It's like, how do we change the next quarter? What are our priorities for the next quarter? And then how do those tie in again to the business plan and the financial results? Do
you ever break out who's accountable for certain numbers or who's responsible?
Yeah, accountability is obviously a big part of setting the quarterly goals. In this example, I wrote out notes, basically what's happening on the financial side of things. But if we were to look at,
like, when you look at numbers on the financial side, does it, like, I guess when you're dealing with multiple owners or management team, that's where that would come in. But if it's just one business owner, then obviously they're accountable for everything. But if they have people on their team, maybe it's somebody else assigned to this number to make sure that that happens beforehand too.
Yeah, I mean, I think the business owner ultimately is responsible for the end result, the profit and loss statement. But there are people who are involved in the daily activities who are accountable. And what happens is when the financials aren't as we planned, it usually goes back to accountability. Who didn't bring in enough sales? Who dropped the ball on the delivery side? And then that's when as a business owner, you can go and correct it. And we really should be doing that more on a week. I know we're talking about quarterly right now, and we can go back up to weekly. But the weekly cadence activities will help you stay on top of that. So by the time we get to this quarterly meeting, it's actually not a surprise. We're not really talking about the past. We're actually talking about what we're going to be doing the next quarter.
Right. So, I mean, you're keeping everybody tapped in. So then what do we move on to when we're looking at even smaller rocks, pebbles in the monthly?
So I'm actually going to go back to weekly, because this is how my brain works. Because typically what happens is we finish the business plan and then we're jumping into a weekly meeting with the business owner.
Okay.
So once we've got the plan set up, we've set up targets during that meeting. So during the weekly meeting, foundationally, every business should be looking at their accounts payable aging report weekly. Every business should be looking at their accounts receivable aging report. Every business owner should be looking at their cash balance. And we talked about in a previous episode having a target cash balance. So maybe every week you're looking at your cash balance versus target. And then some other things that would come from the business plan. One thing is the finance scorecard, what we call finance scorecard at Momentum. And the finance scorecard helps us know on a weekly basis if our business is trending in the right direction or wrong direction. Are we building equity or are we declining? So this is really helpful for scaling businesses. And it's very simple. We actually use Liveflow to automate it. So it's all automated, but it's a weekly look at things that are happening on your balance sheet. So your working capital trends. So you're looking at your cash balance, your accounts receivable balance, your accounts payable balance, and then maybe a line of credit if you have a line of credit. So if your cash is going down, your AR is going down, your AP is going up, and those are bad, right? And so it's just more of like a way to keep a pulse on your business on a weekly basis. And then we'll also look at your weekly revenue, your weekly invoicing, and your weekly pipeline numbers. So you can see here how it's like, hey, if the business owner is looking at this and we haven't sent out any invoices this week, we had this happen with a client. It's like, no, there should be more invoices going out this week. So he got out of his chair and went and asked whoever does invoicing, hey, why you didn't send out the invoices?
They were busy doing Christmas cards.
Yeah, it always comes down to that, right? But you're not waiting like 2 months later to figure out that somebody didn't send out the invoices on time. And this is definitely more for a $4 million plus type of business where there's just more going on. But you can see like if you're scaling really quickly and you don't put some of these things in place, how things can get out of hand.
For sure. Yeah. Well, this is another thing that really closely aligns to the EOS method. And we create a scorecard that we look at weekly in EOS, and we set the metrics that are going to be populated. We don't have a fancy tool that populates it automatically. I think people are still manually pulling numbers into the spreadsheet. Unfortunately, Liveflow doesn't work with Xero yet. So most of our stuff is in Xero. But yeah, so that scorecard that we've created are the things that we look at. And it might be a little different for everybody too. It sounds like you have some standards that you use for every business. It's universal, but maybe you add a couple of things in there that's specific to that particular business so they can reach their goals.
Yeah. So what do you guys look at on a weekly basis?
We talked about it in the reporting or in the KPIs episode, I think last week. It was, I look at some of the overhead big numbers. I'd have to pull up our scorecard, to be honest, to tell you right off the top of my head. But most of it is our recurring revenue. Let's see, I've got that up now. We've got our number of clients. We got a lot of numbers that we look at there. So we have new leads, consults, proposals accepted, dollar amount of proposals accepted, number of new monthly clients, number of lost clients, dollar of total, receivables. Yep, AR, total completed work for the employees each week, the dollar value, overdue work, monthly recurring revenue, monthly lost revenue, and then the roll-ups. The roll-ups are the ones that I look at. So this is total monthly clients, monthly recurring revenue, monthly MRR, and then average revenue per client, ARPC. So those three I look at are typically like everything else rolling up. And they're like color coded too. So if it has a certain number, it goes green automatically, or red if it's too low, and if it's really good, it's blue, stuff like that.
Yeah. So you've defined the day-to-day activities that drive toward your goals. So how did you arrive at those targets?
Yeah. So a lot of it was backwards, where we would look at before we even started tracking any of these numbers, we didn't have a baseline. So it wasn't like you could budget or figure that out. We just had to figure out what it was looking back. So we went to the past year. We defined those as what are the things that are going to get us to our goals. And if our goals were this number of monthly clients, this number of revenue per employee, or whatever the bigger numbers that we were going to track, and then we broke them down into, okay, what's something that we can look at weekly that drives these results? What are some of the factors that contribute toward that? Some of them are lags. A lot. We tried to create as many leading indicators as we can in here, just so it keeps us looking forward and we don't see something that's broken after it's been broken. So these are things that should tell us we're in the right direction, on or off track, sort of. I think we started with sales and looked at, how many leads. That's why leads is the first one. How many leads did we have come in? And it just shows how many leads per week. So as I'm looking at this, like on average, we used to be getting 6 to 7. Now it looks like 4 to 5, 4 to 3. Okay. So if I were to be looking at this regularly, I would say, well, what's going on with our leads? January and February of 2023 was a lot higher than it is now. So what's going on? What's different?
Interesting. Yeah. And then you're also comparing it to last year because there's seasonality around our business in terms of when we get prospects and leads that come in.
Sure. Yeah.
And that helps you because you're not involved in the day-to-day ops of the business anymore. You're just advising at this point, and you have other people running the business. So that helps you then keep an eye on that. So you can go back to Chris and Matthew and say, hey, why has this gone down? What do we need to do? What levers do we need to pull on the marketing side to keep that? Because otherwise, if you're not keeping an eye on that, all of a sudden, if no leads are coming in, we don't want to get in a situation where now we have to lay off an employee. Then it's too late.
But yeah, and fortunately, like in the beginning, I was responsible for some of these numbers that I went off, and they were my responsibilities because I was still in sales or I was still doing marketing. And so I looked at them a lot more closely than as I'm further removed. I'm not accountable for those numbers to go up or down. So I'm just kind of reviewing them after the fact. That's why I look at the roll-ups. But yeah, creating this was, it's sometimes you have the tendency to put too many numbers on there. That was definitely the case with us. I think you want to make sure you put the ones that matter and don't go overboard, because it may feel like you need to put a lot of data points on there, but then it's harder to focus when you're looking at that report and to know what to focus on, because there's just too much. So I think that's one important thing to keep in mind when you're looking at these rhythms. Try to make sure that you're putting numbers on there that are actionable, that you can do something with those numbers too. Otherwise, maybe they're more reserved for the quarterly or for the larger roll-ups.
I also added on here, so for some of our clients we work with that are super, super tight on cash, we will do a 2-week by day cash flow forecast. And that's really part of the AP process. And so something you might do weekly with your bookkeeper is look at that. They should be filling out what's coming out in the next 2 weeks on a daily basis, and then make a decision around what bills you can pay.
We're going to roll up to monthly now. So we've been looking at these other numbers weekly. Yep. These are all the things to look at on a weekly basis. Now let's get to the pebbles. And we worked our way to the middle.
Yeah. So on a monthly basis, we're pretty much looking at your backward looking financials, and the financials tie everything together. They basically are your proof that what we think is happening actually happened, and we're not missing anything. So I like to look at your trailing 12-month profit and loss statement by month, and then also looking at your 50, 30, 20 percentages. Again, those could be different than 50, 30, 20, but like what percentage is in direct costs, what percentage of revenues and overhead, and then what's your net profit, and then compare that to your goal. Balance sheet. So a standard thing that you want to always do with your accountant is go through your balance sheet. And this is just a control to make sure that the thing about accounting is it's so complex that a lot of business owners, they just ignore the balance sheet completely. But we need to be looking at the balance sheet. We need to be making sure that the numbers make sense. And it's really not that difficult, because if you go look at the balance sheet with your accountant, then they should be tying out your loan balances. There should be a prepaid schedule. They should tie to your bank balances. Everything should tie back to something. One thing I will say, it's funny because the last week I had 2 clients come in and I looked at their AR aging, and like there was just a ton of negative balances on it. I'm like, are you not looking at your accounts receivable aging report because if that's off, that means your financials are so off. If you've got negative AR, that basically is saying that your customers owe you money, which I know is not correct. That's another thing.
No. That's saying you owe your customers money.
Yeah. Is that what I said?
You said you owe your customers money. Well, no. Your customers owe you money. But
No. It's they owe you money in
AR. Yeah. That was if you owe your customers money if it's negative. Yeah.
Yeah. I had that happen, come up twice in the last couple
of weeks. That
weeks.
does sometimes happen. Like people have refunds maybe that they didn't issue, but never should it be negative.
It was, these are things from 4 years ago that are still on there. So just a massive cleanup that needs to be done. But that's why you should be looking at your AR aging and your AP aging weekly. And if they're negative and it's over 90 and you know that doesn't exist, that's a real indicator that something's wrong.
Yeah. I know that a lot of tax accountants don't pay attention to it until it's time to do the tax return. That's not our firm, but a lot of the firm that I took over, you should have seen some of the balance sheets of the people that he was supposed to be doing monthly books for. I'm looking at the balance sheets and there's bank accounts with negative $1 million in it and crazy numbers in there. This was an old write-up software, but Just make sure that if you get a tax accountant that's not necessarily looking at all these until the end of the year, their balance sheet's going to be off anyway. Like you said, like there's a lot of numbers in there that just won't matter. They're using them as plug accounts almost.
Yeah. Make your accountant, like meet with your accountant every month and have them go through and explain what every balance sheet number represents. And if they can't explain it, then that's a red flag.
Yep.
Okay. So balance sheet, P&L, and cash flow are pretty much the three main accounting out of your accounting system reports you should be looking at. So just real quickly, I want to go through looking at the cash flow statement because a lot of accountants don't really know how to look at a cash flow statement. It's actually pretty simple. So there's three main areas on your cash flow statement. There's the operating section, there's the financing section, and there's the investing section. I might have done that. No, I think it's operating, investing, financing. But basically, the main ones for small businesses is so the operating section, there's going to be a bunch of crap in there on your, I like to look at the trailing 12 month over month operating section. I just condense all of that crap that's going on in there, that whole section from a report from QuickBooks Online. Just look at what you got from operations. And that's basically between what you collected from customers, what you paid your employees, what you paid your vendors. This is the net cash flow from your operations. And then if you get into the next section, that's typically things that are happening on your balance sheet, like you're buying some sort of equipment, fixed asset that gets capitalized. And then this third section is really where most of the meat is. So that's typically if you're taking out money from the company as the owner, that answers the question of like, okay, I'm profitable, but why do I have no cash? Well, taking out that profit distribution ended up on your cash flow statement, not your income statement. I just have a prospect right now that on their net profit, when I look at their net P&L net profit, they're showing 40% net profit. So I'm like, okay, that's cool, but let me go look at the cash flow statement. So I go look at the cash flow statement and they've got their regular distribution on there and what it's called a payroll distribution. And so I'm like, okay, well, let me just on my reach report here, take out the profit distribution that's running through the balance sheet right now and throw that on the P&L just to look like and maybe it's going to be reclassed as a guaranteed payment. But anyway, just to see like after they actually pay a reasonable compensation for the owners, what the net profit
need to see that the owner's compensation is on the P&L, because if they were to be replaced, that's definitely an expense for the business.
Exactly. So I was taking some portion of their distribution and saying, okay, if this was a reasonable compensation for an employee they had to replace, what does the business look like? And then it dropped it down to a 20% net profit. So they're looking at their P&L thinking, we're really profitable. We got a 40% net profit. 20% is still great, but the owners are doing all of the work. So if they actually go hire somebody, then is their profit going to be 0%? That's the question we need to answer.
Yeah. And to bring that point to life, on my business, I have removed myself from the expense line item. So I'm an owner that doesn't actively participate in anything in the business. So I've effectively replaced myself. And now my distributions don't show up. I don't even take owner's salary anymore. So that doesn't show up in there. So I think if that's a goal for some of our listeners, some of our students, it's an admirable goal. And then you can remove that. But while you're actively participating and generating revenue and everything for the business, you are an expense to the business. I like this because it brings to life what we were talking about last week, KPIs, and we were talking about different things to be tracking. And this is where they are tracked on some of these reports. So, we kind of repeated a lot of the stuff from last week too, or a lot of the metrics that we were talking about. And now this is in action, what those things, how they impact you as a business owner and when you should be looking at them, how frequently.
If you are doing any sort of P&L or cash flow forecasting, you might also look at that on a monthly cadence. I'm of the opinion, what I've realized over the years is that if you are actually monitoring the day-to-day ops really well and you have KPI goals and cash balance goals, you don't really need a forecast. Some business models,
take.
Yeah. So some business models, I call it cash maintenance. There are some business models that require a lot of cash maintenance. And so examples of those would be like creative agencies or businesses where you have projects, long projects, timing difference in when you're getting paid, you're working with large companies or consultants that are working with Fortune 500 companies. There's just a lot of variability. And so you have to take that into account when you're managing that business, that you need someone managing cash, whether that be through a forecast or a CFO, whatever. Same with inventory-based businesses. Because you are laying out the cash way in advance to buy the inventory, there's just things can go really wrong if you don't manage it really tightly. But there are most businesses, like a business like ours that has recurring revenue where we're getting paid up front. We don't really need to do a regular forecast at our size. It's just like extra work that if you actually manage the business properly, is not needed. It's just an extra expense.
Only if things got volatile or if you wanted to experience some more rapid growth. That's when a forecast might be necessary. But if you're maintaining, like you said, cash maintenance, this is a great take that you've had, because you've actively been looking at forecasting as the next frontier, or something that you thought you would want to offer for your clients. But now you're seeing maybe it's overkill. Maybe if everything else that you're doing, if you're doing all the other right things and you're maintaining, maybe you don't necessarily need that. But it is important for different volatile businesses or businesses that experience a lot of, well, I was going to say volatility, but experience a lot of seasonality too, or unexpected things that are going to hit those rhythms and make them that make the frequency vibrate a little bit faster during certain times. And it's something that you're not used to. A cash flow forecast would be helpful.
Yeah. And if we have a business plan and then we have our finance scorecard, and our finance scorecard starts going in the wrong direction for many weeks in a row, then we might say, okay, like let's update the forecast, or let's do now it's time to look at that. So we're not doing exercises on, if a company's like generating crazy amount of cash and they have tons of excess cash, isn't really that valuable if they're not going to actually, it comes back to the so what behind, why are we doing this? Why are we tracking this? If we're not going to do anything about it, then we don't need to actually take the time to make things overly complicated. Now, for my business, I do have like at the beginning of the year, I'll usually do a plan. And then if I want to make a decision on hiring somebody, I have that ability. I can go in there quickly, be like, let me add that person and see like if it makes sense. And so that might just be like more of a one-off, but I'm not having to go I'm not every month or every, 13 week or every week updating some sort of forecast.
Yeah. Yeah. Well, it reminds me that I need to take a look at ours, because now that we've been in maintenance for a while, I want to make sure that we're maintaining, and I want us to start growing too a little bit too. I want to ignite my team to maybe think about hiring somebody and taking on more business. So yep. We've been in talks.
Did you get mad because my MRR?
Yeah, your MRR is higher than mine,
yours?
so I'm a little envious. And I'm now pushing them to say, I even nudged them a little bit. I said, Nikole's MRR is a lot higher than ours now, and it's going to take us a while to catch up. We don't take $10,000 a month clients on, so we're not going to bump up from 90 to 100 in one client. But, we don't have as much volatility, let's just say. It creeps up. It's higher than it was, but we're still trying to get our average revenue per client to about 1,000. And that's like about 900 now. And we're trying to get our monthly to above 100. And that's always been hovering around 90. It's like our artificial capacity is what they've kind of determined. It was like 88, 89, 86, 90. Like it's always been around there. And that's because we haven't hired anybody else. And they think for that to blossom, we need to hire somebody else. We need another like client facing person.
But if you hire somebody else, don't you need your leads that come in per week to increase?
Yep. All of that has to change.
So how are you going to how are you going to change that?
Well, usually we can drum up more leads by getting some more Google reviews. Google reviews is a great way to get more local interest. We already have a ton of Google reviews and we show up pretty high anyway, not for SEO, but just because the reviews, it put you on the map. So you show up really high in there if you have fresh reviews, and whenever your reviews start to dim down, which usually it has, we got to get our team to ask clients to leave reviews. So got to drum up some fresh reviews, And then all of a sudden the leads just
Really?
skyrocket
Interesting.
again. Yeah, it's crazy. We used to get like, if I look further back when at our peak, our signs were up at 3 locations basically. And that's what brought in all the leads. So 0 directory, ton of leads from there. So business owners would go in there. And this is for our listeners too. If you're professional services and there's a software that your clients tend to use and you want to attract more of those clients, then try to get on that directory if that software has a directory. For us, it's fairly straightforward because a general ledger like QuickBooks or Xero is going to have the accountant directory, as well as a lot of other apps that we use have other accountant directories. And so that's how you can find us, through there. And that's where we put our sign up, and we would show up on everywhere for Xero because QuickBooks was too competitive at the time. Too many accountants on QuickBooks and not as many on Xero. Xero was like the low key, like more advanced accountants were using it. I was, a lot of our friends from our core were a lot of Xero users because it was first on the cloud. So we got a ton of leads through there. We would get a lot more maybe than we do now. And then Gusto, another software that a lot of small businesses use, has a great accountant directory there. We paid a lot of attention to our listing in there to make sure that we had a good listing and that people would see us and we were prominent. So that was like the signs that we put up, right? So Xero, Google, I mentioned how the reviews, how important that was. It wasn't our website that people were searching for. They weren't searching. If they were searching for an accountant and they were in our geographic vicinity, boom, we showed up. If we had and we had more reviews than anybody in our local area. At the time, it was like 40 reviews is all it really took, because most accountants have none. They had maybe 1 or 2. And so they wouldn't show up. And that's how people were finding you, because I need an accountant. I'm just going to Google accountant in my area.
Yeah.
And our area has always been growing with a lot of local businesses. So we always do pretty well with Google. I'm interested to see what the shift is for accountants, because those 3 things worked for us all throughout. And I think not just for accountants, but for anybody, I think you have to find what works for your business and then really pay attention to that and continue to drive that. Don't waste time on that doesn't work.
Those strategies never worked for our firm, I think, because we came on a little bit later. 1 and 2 were low volume, high touch. So for you having hundreds of clients on Xero or Gusto and having good reviews, they're going to push your firm to the top because you're selling a lot of their software. The SEO approach doesn't work as well for us because our services are more consultative. So it's not just like, hey, I need someone to file a tax return. And so I made a lot of mistakes with marketing on the wrong areas, and then ultimately realized our strategy is more of like, or has become educating.
Well, insider
content.
tip, creating a podcast and speaking directly to your audience, to the business owners. That's a way for and anybody with a really high focused marketing niche, or not marketing, but like business niche, specific client that you're talking to, and knowing that client inside and out and knowing what you can do for them, that becomes the high touch, low volume approach. And being there and ready for that client when they're ready to work with you. We've learned this a lot through our other show. And we know, like, especially for professional services, if you are the expert in that area, and if you're somebody that works with a specific client, then start going to those places too. Go into their watering holes. You used to go to a lot of networking meetings or places where you would find your clients, and that's how they got to meet you in person. I think a lot for you, your early success was being there, meeting them where they were at. And it was in a lot of these networking meetings, and you were the accountant. Is that right?
Yeah. Meeting people who are also servicing my same ideal client profile. So I was I'm still in Provisors. I don't go as much as I used to, but I basically built my business going to networking meetings through Provisors. So if you're just starting out, it's a great way because you start getting relationships with people. And if I could go back in time, I would have been way better about building my email list as I was meeting people along the way. Ultimately, we have a newsletter that goes out that helps me stay in front of people I've met in person over the years. Because the thing about networking is you might meet someone one time and you spend all this time to drive across the city to go meet them for coffee. But if you don't stay in front of that person, they won't remember you. They're going to remember the last person that popped up in their newsfeed or sent them an email or they met in person. So it's just thinking of that person not as a one-time meeting, but how do I continue to stay in front of them over the next amount of year, over the years?
Well, we love to talk about marketing here at the Cash Flow Show.
A little off the rails here.
Yeah. Well, it's not off the rails because this is just a teaser for our future marketing episodes, because that's important for your cash flow too. It's important for your sales. And we know a thing or two about marketing just from our own businesses that we could share further. But to go back to your original question, you asked me about how did we find our numbers, because you were starting to go to the next phase of this reporting rhythms conversation. And that's the forward looking. Is that right?
No, we already talked about the forward looking.
Oh,
I asked that because I was trying to tie it back to your plan, the annual plan.
Ah, well, it was good. This is a good lesson too, in that it's sort of like you were my advisor right now as I was kind of talking about the new developments. But yeah, I mean, like every business, you got to, I'm not going to say you got to grow, but because that's my team is still giving me pushback. But I want to go back to the reason why I said all of that. And when I was talking about the marketing is that I do think that the business needs to grow, because that was my biggest insecurity or concern with the business, that it's just standing still. And it's not necessarily, and if it doesn't grow, then you're dying. And that was that's an extreme thing, but somebody said that on my show. And they said, if you're not growing, then you're dying. So I feel like the firm does need to grow. I know I always say my guys are in maintenance mode, but I want to see them growing it, and I want to see that happening so we're more adaptable. And when the next existential threat comes, I'll be at the door waiting for it. Right now, we haven't gotten hit with any other existential threats yet, but they're looming. They're right there at the door, and I'm holding the door.
Well, you've been able to exit. I think of it that the business is the getting out of running your business in exit. So like first you exit the client work, then you're exiting the operations. Usually the last thing a business owner can exit is sales. But really the last thing is how do you exit a business and then have it grow without you? That's like next level. So I'm curious to see, like, you've done an amazing job of like building this passive asset for yourself, which is incredible. Like, I would love to get there one day. Like, that's my goal. But now can you get to the next level of having it grow without you? So
well,
I'm excited
too. I'm excited too. My team was talking about all the different sales calls and positive things, and that's lighting me up before it would make me anxious if they were taking on new business, because then it's like, oh, now it's more commission to pay out, or now we got to think about hiring somebody. But I'm actually a little bit more, I think we can hire somebody. I think we can do that. That's the biggest fear for our industry, is the pipeline problem. There's fewer and fewer accountants these days. Probably harder to find an accountant. If you're listening to this show, we are accountants for you if you can't find one. But for us to hire people, this is an issue. It's been an issue for me, and that's part of my fear.
Are you looking for another tax accountant, U.S. based?
I don't know yet. I don't know what we're going to need. I think we're going to need somebody that's client facing, and I don't necessarily think it needs to be a tax preparer. I think it could be somebody that could just manage the relationship, and we have tax preparer.
Or
overseas.
Is there anybody existing that could be leveraged more through hiring somebody to come underneath them?
We've done it. You're
fully leveraged.
Not fully leveraged, because we're just not big enough, but there's nowhere else for anybody to go in the U.S. They're like, we've constricted and condensed the team and the crew, and everything has been like, this is ready to expand now. I think contracted, and now we're back to expansion mode. We pruned all the hedges, all the bushes, everything looks good. Now it's time to grow again.
You're ready.
Yep. Dope. Any other things to discuss on reporting rhythms?
We covered a lot today, but just remember, there is, like, with accounting, our whole life is what are we doing on a daily, weekly, monthly, quarterly, annually basis. And as a business, when you're looking at your financial activity, you should be thinking the same way. You should be working with somebody that's queuing that up for you. And you shouldn't be the one having to figure out what you should be looking at. They should be helping you based on what your vision is and the operations of your business. They should be helping you figure out what it is that you need and then serving that data up to you.
So I saw the movie Argyle last night. Me and Juana went to the movies, and a cat was the star of the show. Cat saved the day. Little Maine Coon cat Cute little cat. It was in the whole movie. I don't know if you ever saw any
Really?
previews of it. Yeah. It was like the main character's cat that she carried around in a cool backpack with a little bubble like window. So when you saw her carrying her backpack around, you would see like the cat's face. Yeah. I just saw your cat pop up and I remembered the cat saved the day at the end of the day.
What's the name of the movie?
Argyle.
Argyle.
It's the new Apple Films movie. Yeah. It's pretty good. But yeah, back to cash flow, back to businesses. This is the Cash Flow Show. Thank you, everybody, for tuning in on our very special Valentine's rhythmic episode. We're gonna exit with our exit music. Thanks a lot for tuning into the Cash Flow Show.
See you next time.
Yeah. So you're drowning in cash flow issues. You run a business, but feel like it's running you. Customers won't pay, but you got bills due. It appears you won't have enough for payroll coming up soon. It seems like you running nowhere fast. You work hard, but never able to withdraw cash from the business. You get more customers, hire more employees, but still take home hardly anything. You feel like you're on a hamster wheel, frustrated cause the battle's always uphill. Even though you got a bookkeeper on your team, they send you reports, but you don't really know what they mean. Your CPA doesn't understand a thing about your business, at least that's how it seems. But if you want to get above water and grow, check out the Cash Flow Show. This is the Cash Flow Show, where we help the small business gain momentum and become profitable. This is the Cash Flow Show. Listen and learn. We'll show you how to pay yourself on what your business earns. Cash Flow Show. Discuss topics like getting paid on time, profitability, and managing your bottom line, payroll best practices, the best apps to use, and cash flow forecasting tools. So if you're a small business owner, your help's right around the corner. Fret not. Tune in as Scott and Nikole help you reach your goals on the Cash Flow Show. The Cash Flow Show, where we help the small business gain momentum and become profitable. This is the Cash Flow Show. Listen and learn. We'll show you how to pay yourself on what your business earns. Cash Flow Show. Our advice will take you far. Cash Flow Show. Tune in with Nikole and OKR.